Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is July 29th of 2021. A lot of headlines, moving markets. Markets are going higher, and I'll tell you why. Thanks for watching. So I'm going to go through a lot of topics right now, but we're going to start off with the most important right now. In the U.S., and it's a very serious topic, the Delta variant is spreading extremely rapidly. That being said, why are markets up? Why are markets rising? Both here, but globally. As an example, as I said, when I first started reporting to all of our clients as we were through this pandemic in the last 18, 24 months, and I've been coming to you live directly, if you will, on my updates. Thank you for watching, as always. But more importantly, what are markets seeing and why are markets up since the variant here is on an exponential slope up? They're rising, right? How could markets be up at the same time? It doesn't make sense, Rob. Well, the real answer is, if you look at the origination of it, according to science and doctors, and I'm not, so this is what I just have sort of picked up in our research, is that it started in India, this variant, the Delta, and very specifically, you're looking at the markets right there are up 12%, right? So those markets are already seeing through it. Again, Great Britain is ahead of us, right? They're about a month and a half ahead of us in terms of this variant within Great Britain. Their markets are up, but at the same time, the cases are down. So what the market here is doing in the US is looking around the world. Markets see through the noise and the data and the headlines of the night. And it says, wait a minute, they're long-term assets. These companies are long-term assets, right? When you own a company and you invest in stock, it's a long-term asset. So it's not for just a 60 days or short-term trade. This is a sort of a long-term investment. So you're going to have, markets will see through the short-term spikes. Again, the US right now, our cases are rising. We're about a month and a half, maybe 2 months, I don't know. But it happened the same pattern last time, and maybe the same pattern persists this time. We have to wait and see and pray that the rising cases fall rapidly and sooner than later. That being said, we just got the print of the second quarter GDP in the United States, and it was 6.5% right now. That is huge. Right now, what that means, if you add it all together year over year, the United States is now back on track with actual growth. So pre-pandemic levels of growth. Remember, I said the GDP is about $19.2 trillion at the end of 2019, at the very beginning of 2020. That being said, we're there again. And obviously we've had all the fiscal stimulus, we've had a lot of that savings and everything else building up, and I'll talk about that in a minute. But this is a significant number. We haven't seen that number since like 1983, which is unbelievable. So this is huge right now. It just was reported before I got on the air here. And now here's what's important. This is another reason why markets are rising. Out of the Fortune 500 companies in the S&P 500 right now, remember we're in the second quarter earnings season where they report, 176 companies have reported, and 87% have beaten expectations and 83% have beaten on the revenue side. So both expectations and revenue. This is real, folks. This is not just one or two. This is every single company is outperforming in a very significant way. So earnings are going in the right direction, probably 2 or 3-fold from what everyone was expecting. And that is another sign of growth. So you have the GDP growth, right? The economy is growing. Everyone's coming back out. You have the companies being able to make money. They're growing. And let's go to labor. Companies are making money because they're doing it short-staffed, right? We see it on the headlines, like the JOLTS report, which is the job openings. More companies are looking for more people. We're trying to hire at Blanke, Schein Wealth Management, and we can't find, it's almost impossible right now. And so we're sitting here and we're growing rapidly here. And we're seeing the same thing. All the small business owners I'm talking to, every company report I'm reading, every earnings report, and every CEO, the JOLTS report, the job openings report, is really indicating that the economy is really hot, right? We already have the two evidence right here to support that claim, and they need the labor force. Now, in the meantime, why earnings and revenues are up is because they're doing more with less people, right? You have higher earnings because you don't have the labor costs right now. Now, that'll slow down, and these will temper as we get into 2022. But in the meantime, that's another reason. Now, labor projected to be by fourth quarter of this year in the range of coming down, the unemployment. So unemployment is trending in the right direction. We could see a 4.5% to 5% print on a unemployment report, which is wonderful. That's a really healthy economy. Inflation is hot, just like it is in the desert right now. It's like 110 degrees. But what we know and what the Federal Reserve is actually telling us is, and this is interesting, this is where the debate really happens, is that it's transitory, meaning that the summer heat is only in the summer and it's only for a period of time and it's short-lived. And so if you can survive that and get through to the winter time or the fall here in the desert where it's gorgeous and beautiful and 70 degrees and sunshiny, it'll be okay. And that's what the Fed is sort of projecting right now as it relates to its transitory inflation read. That being said, every small business owner, everyone that I've talked to, everywhere I spend money, whether it's the grocery store and the shrinkflation where everything's smaller but it's still charging the same price, or we're just paying more for autos, we're paying more for everything we're seeing, I don't know. Education, healthcare, so on and so forth. I'm paying more personally. I bet you are too. So we'll see how transitory this actually is. Inflation is really a tax on everyone, especially in the middle class. And this is going to be a persisting common theme and problem that we're really going to have to pay attention to. But hopefully we get closer to cooler weathers and hopefully inflation then subsides at some point in time in the future. But I don't think so, because you have the labor market so short and so tight that you're going to have to fight for employees. So that you're going to see wage inflation take hold. That's really could be potentially the underlying issue on a go-forward basis that we're going to pay attention to. Now the Fed, they basically have indicated right now that they're going to not raise rates again until 2022, the back end, maybe December. I don't know how they could predict that so clearly with all of this key information going in a hot direction, if you will. But that being said, they're going to stick to their guns at this, at least right now. And they are indicating right now, which is the words in their report, that they're going to start tapering or slow the purchases of the MBSs, the mortgage-backed securities. What does that mean? Well, the Federal Reserve actually is going in on a monthly basis and buying bonds in the marketplace, a percentage of them, right? Treasuries, mortgage-backed securities, and even corporates, if you will, to provide liquidity to keep the markets moving, right? They had to do that in a crisis level, and they're going to continue to do that. That's their commitment to the market. But once they start tapering and bringing that support back and stop buying, if you will, those bonds, they said this is going to be the first choice of sort of tapering, if you will, the mortgage-backed securities. What does that mean? That means it's going to impact interest rates and real estate market in the future. That's another key thing we're going to be paying attention to as it on a go-forward basis, because real estate's super hot right now, and mortgages are very, very quick and liquid, and so on and so forth, and interest rates are super low. If the Federal Reserve pulls back just a little bit, right, that could impact both the real estate market and mortgage rates and interest rates. So this is going to be playing out in the future. We shall see. And then finally, the M2 money supply, which is basically a read of all the money in the banks. That's personal and corporate, if you will. If you've got money in the bank, the bank is not paying you anything, like 0.25%. That being said, they're lending that money out, right, at the mortgage rate at maybe 3 or 4%, making money on the spread, or they're leveraging it 10 times. Right? They have the ability to take our money that are on deposit in a bank and do a 90% leverage on that money. That's insane, right? And they're making money on our money. But that being said, in the meantime, there's 17% read in terms of highest, one of the highest rate. We were at 23, 24% earlier this year. It's coming down a little bit. It just means that there's money piled up in the banks. That's good for corporations. It's good for consumers. That means that money will go back into the economy. That was the Federal Reserve's playbook. That was Congress's playbook. Give money out and hopefully it'll be spending. So this was 23%. It's coming down now, but there's a plus. Rob, what does that mean? Well, we know that there's an infrastructure bill right now. We know that Congress is talking about reconciliation bill. We know that there's more stimulus ahead because somehow, some way, there's some subsectors of the economy that still need support and help, maybe labor force and unemployment. Who knows how this plays out? But we know that Congress right now is looking at ways to help out and continue to boost this growing economy. But overall, that's sort of a summary recap, if you will, of what we see in the markets, why the markets are up, even though the Delta variant cases are up as well. And so this is what I want our investors, our clients to keep in mind, is that the markets are seeing through the data and they're looking into the future and they're saying that there's growth ahead and it's sustainable, which is a very positive thing at this point in time. So that's my update for today. Thank you for watching. Again, stay healthy and safe, and we'll see you again next time.